Before we start this video, do like and subscribe to our channel and not miss on any updates.
That is, one of these logics is only right. Both of them are not right. It is impossible both of them can be right parallelly. No, because one of them gives sales of a different number, other one gives sales of a different number. So what do you do? How do you decide? Because it's a very twisted, very dirty, very poorly framed question. Fundamentally because you can compute the turnover using the first ratio also. I don't know why they did not take it. I am unable to know the logic. If you guys are able to figure out that logic, let me know. Because it is not at all clear here. And I think they made a mistake here in this current EPS as 6.99 or something they took. That I think they'll correct at a certain point of time because they themselves know that the EPS is not 6.99 but 6.03. Okay. So in this question, I think they made a mistake. The answer has a different one and question has a different one. These three numbers, whatever I am highlighting, they're actually double their value, okay, in the answer. So we have to take them as 581.6, 1343.8, 88.4. This is what happens when they copy data from somewhere and don't change the numbers. You can theoretically work out this way also, okay, but I don't know why they choose only one method. See, it's not. See, you have given part data, boss. I mean, this is so unfair that you can give half data from here, half data from there, then partly you don't give the data. It's very, very unfair. So guys, the CA final AFM Jan 26 RTP has come out. Now, I've gone through the RTP briefly and most of the questions, right, quite a few of the questions actually are repeated from, either past papers or their mock test or model test papers or some are straight from study material. Okay, so let us go ahead and solve. Now, one of the feedback I got in the last 2 or 3 occasions when I uploaded an RTP video was, sir, if you're just going to give, one line referral for each question or one line reference for each question, this is there in that video, this is there in this video, this is there in that file, then don't do the RTP video. So I've actually literally taken to that comment to heart and I'm actually going to solve most of the questions. However, I will not do a detailed solution because anyway solution is visible to you as part of the RTP. But what I will do is I will try and explain the solution and solve it. Of course, I'll definitely be putting pen to paper and the goal is to basically make this a video which actually will assist you rather than just ऐसे ही कुछ कर दिया है, right? Because that was one of the feedback somebody gave me last time and we very, very strictly take student feedback and try and improve ourselves. Okay, so let's start off. So, questions first, I think they have given the MCQ questions. Grow more and NBFC is in the need of. So, this is from their MCQ case study booklet, okay. Is in need of funds and hence it sold receivables to MAC Corporation for 100 million. MFC created a trust for this purpose called General Investment Trust through which it issues securities carrying a different level of risk and return to the investors. Further, this structure also permits GITU to invest surplus funds for short term as per their requirement. MFC also appointed a third party. So, let me see. First, I'll draw. Grow more. Is an NBFC, okay, sold to MAC, they created trust, GIT trust, sold securities. Here they were selling receivables, okay. Further, structure also permits GIT to invest surplus funds for short term as per the requirement. MFC also appointed MFC stroke MAC. MFC is MAC Financial Corporation. Okay. Appoint Safeguard Private Limited, SGL or SPL to collection agent. Okay, collection, and pass it on to GIT. Okay. It will also follow up with defaulting complaints and if required initiate appropriate legal action against them. From the following information given above, choose the correct answer to the following question. Securitized instrument issued for 100 million by GIT falls under pass-through certificate, pay-through security, stripped debt fund. So if you remember and recollect what I taught in class or what you would have studied on your own also, there are two kinds of securities, pass-through and pay-through. Pass-through is whatever comes in is passed out. That is whatever, if you get less, you will give less. If you get more, you give more. That is called pass-through. Whereas pay-through securities, even if you get more, that money is retained with you, it is reinvested and the surplus is given back. So, the answer for what is the kind of question here? This structure also permits GIT to reinvest surplus funds for short-term requirements. So, that is a pay-through security. It is a pay-through. So, it is a pay-through security. I am circling it in this. Okay. Okay, then in the above scenario, originator. Who is the originator? Growmore, Mac Financial or General Investment Trust? So you see, this was a twisted question. Even though GM is the original NBFC, they have actually sold it off to Mac, and Mac is the one who created the trust. So the person who creates the trust, or the entity which creates the trust, is the originator, not necessarily the person who was the original owner. Okay, so this is slightly twisted logic because I don't think they explained it that way in the material. So if you have marked Growmore, right, that is not correct. The correct answer is Mac Financial Corporation. The logic is not the person who is the original party who is has the receivables, but the party who creates basically the trust, or who has the ownership of all the receivables and then chooses to create a trust. Okay, then in the above scenario, GIT is what? Obliger, originator, special purpose vehicle, recipient, paying agent. GIT who is the GIT? They created a GIT trust. GIT trust is what? See, SPL is receiving and paying agent. So GIT is what? GIT is obliger, originator, SPV, or receiving and paying. It is SPV. Answer is SPV. Why SPV? Because all the receivables have been moved to a trust, and the trust is going to go ahead by issuing securities. So whoever issues the securities is the SPV. Okay, whoever issues the securities is the SPV. Then in the above scenario, safeguard is what? Obliger, originator, SPV, receiving and paying agent. Receiving and paying agent. Why? Because they are the ones who are going to be collecting the money. Which of the following statement holds true? When yield to maturity in the market rises, price of, see here, the same mistake they continue to bust. First of all, CA Institute making this kind of mistake is horrible. Principle, this is what it is. Principle, PLE, refers to values, character, principles that I choose to follow in my life. That is what this principle is. Or when you talk about rules, laws, theorems, principle of national justice, so that is where you use this word principle. Principal basically means original outstanding amount in a loan, or even your school headmistress or principal. The correct spelling is PAL. Okay, so these are kind of basic mistakes that you should not do. Institute does, you should not do. Okay, anyway, when Y2M in the market rises, price of principal only securities tend to rise. So PO. Okay, what are they saying? So I'll actually plot this in a table kind of a thing, easier to solve. Okay, easy to at least understand what they are saying. YTM, PO, IO. So what are they saying? 1, 2, 3, 4. 4 options. YTM in the market rises. Prices of principal only securities tend to rise. When YTM in the market rises, prices of principal securities tend to fall. When yield to market in the YTM in the market falls, price of principal only securities tend to fall. When yield to maturity in the market falls, prices of principal only securities remain the same. See, first of all, this remain the same nonsense is not there. Okay, because if it were to remain the same, then what is the price of no security will remain the same and yield changes. So definitely it is not D. Okay, definitely it is not D. Next, you see the logic, and I'm actually not even getting into the logics. Okay, I'm not even getting into the actual underlying reason. I will tell you how to identify the correct answer from this only. See, if up, then down also should be true, no? So if something goes up, YTM goes up, price is going up. So YTM goes down, price should go down. So it cannot be only one of 1 and 3. If you look at 1 and 3 or A and C, right? A and C. It is impossible that it is only one of them, because if it is A, it is also C. If it is C, it is also A. So most likely it is neither of those two. The answer is actually B, option B. Okay, option B is the correct answer. Now, I have told you how to do by elimination methodology. But what is the right way to figure out what is the principal only security? Principal only security is where when you have a loan, EMI, in the EMI you separate the principal and you separate the interest. When you are separating the principal, if let us say the market yields fall. If market yields fall, what do people do? If I am a home loan borrower and I have taken a fixed rate home loan and yields are falling, that is market rates are falling, then what I will do? Existing home loan which is at a fixed rate, I will refinance it. That is, I will repay it. So when I repay it, I will borrow afresh. I will borrow afresh and repay. So when I am repaying the loan, the principal portion, let's say there is a PO security which is basically only principal. The principal is coming back. If principal is going to come back early, right? If principal is going to come back early, earlier what was supposed to happen? The principal was supposed to come back over 30 years. But today you are giving back the entire principal today. So when it is going to come over 30 years, the value is discounted. But when it is going to come back to me today only, the value is not discounted. So I am going to get my money very, very early. So I am going to get a higher amount rather than getting a lower amount over a period of time. So if I am going to get a higher amount, what is going to happen to my security? Security value will rise. Yield to maturity falls, I will get my money early. If yield to maturity rises, nobody will repay. What will happen? People will delay. If they keep delaying, what will happen? My money will not come early. If my money will not come early, it will keep on getting delayed, or it will get paid only at the due date. There will not be any prepayments. No matter what you have assumed are prepayments, those prepayments will not happen. So the principal will come only over the 20-year period. If it is going to come over 20-year period, the present value of that is less. So the value of the PO security falls. So I told you first when the value of PO security rises. Now I am telling you when the value falls. So if YTM comes down, PO value increases. If YTM goes up, PO value decreases. What have they said here? YTM in the market rises, prices of PO securities tend to fall. 100% right. Okay, this is the logic. Now, next, IFM, International Financial Management. A parent company has subsidiaries in France, Germany, UK, Italy. Amounts due to and from affiliates is converted to common currency, US dollars, and entered in the following matrix. Inter-subsidy payments matrix. This is straight from study material, by the way. Receiving affiliate. Who's receiving this much? Who's paying this much? Okay. The treasurer of US parent is suggesting that by applying multilateral netting system, the company can save a lot of transfer exchange costs. The company board agrees with the treasurer proposal. This, I have actually been thinking this is a very important kind of question that can appear in exam because nobody prepares for these kind of stuff, right? Kuch to hai, something is there. Let me prepare whenever I want to go. Or it is very easy, but very likely that such kind of questions could turn up. So please do, have a glance at least once. So, what is it? From the following information, choose the correct answer. Before applying multilateral netting, it is necessary to apply unilateral, bilateral, multilateral and interest rate swapping. So, before you do multilateral netting, multilateral is across all parties. Before you do across all parties, you should first make it, if there is any bilateral level stuff, right, that has to be made zero. If there is any bilateral level stuff, right, that has to be made zero. So, before doing multilateral, how will you do multilateral? No. So, you will have to first do bilateral. Now, what is this bilateral? We'll see. Though, through multinational netting, these transfers will be reduced to what? So, you see, France has to pay Germany 80 and Germany has to pay France 80 and Germany has to receive from France 120. So, you will basically net off 80 and 120. Basically, the difference between them will be 40. So, like that you will do bilateral netting. Now, here what is the question? Through multilateral, what is the, how much will these transfers be reduced to? So, you see, France has to receive 400, France has to pay 480. So, France pay 480. I am writing in short form, easy to understand. Then, Germany has to receive 360, Germany has to pay 260. So, Germany receive 100. So, this is not 480, this is 80 by the way. Net of those two, right? 80. How do I get 80? You have to receive 400 and pay 480. So, you will end up paying net 80. Then Germany will receive net 100. Same way UK. UK has to receive 420. They have to pay 320. So, UK receive 100. Then Italy, they have to receive 380 and pay 500. So, receive 380 and pay 500. So, Italy pay 120. So, what is this? These are the net numbers that you have to pay or receive. So, what will this add up to? France and Italy will pay together 200 each, 200 combined, and Germany and UK will receive 200. So, this is pay, this is receive. So, what is the net number through multinational? These transfers will be reduced to how much? Yes, 200 only, because there are two people who are going to put together 200, two people put together are going to receive 200. So, answer is D, 200. The net receipt for France. Net receipt for France after netting off everything. What is it? There is no net receipt. France will actually be paying 80. Net payment 80, yes. Correct. Then net payment receipt for Italy. What is Italy going to do? Italy is going to pay 120. Italy pay 120. Suppose if the transfer charges are 0.1% of the amount transferred, then by applying multinational techniques, there will be a reduction in the overall cost of transfer by how much? See, overall transfers is how much? 1560. Now, how much has it reduced to? 1560 has reduced to 200. So, there is a reduction of 1360, 1000. These are all thousands, right? Or million, thousands. 1360, 000. Of this, the charges is 0.01%. See, 1% is 2 zeros gone, 0.01% is another 2 zeros gone. So, you will have reduced $136. So, you will reduce $136. That is the answer. Okay, very simple. Then, Advanced capital budgeting. SS company is considering the replacement of its existing machine with a new machine. The purchase price of the new machine is 26 lakhs. Expected life is 8 years. The company follows straight line method of depreciation of the original investment. Scrap value is not considered for purpose of depreciation. Other expenses to be incurred for new machine are as follows: installation, fees paid to consultant for his advice to buy the new machine, additional working capital. WDB of the existing machine is 76k. Salvage, cash salvage is 12,500. Dismantling of the machine would cost 4,500. EBIT annual earnings before tax but after depreciation. Okay, so you can take it as PBT. From new machine would be 31,500. Income tax is 35%. Company is required of 13%. You are required to advise on the feasibility of the proposal. So this is an advanced big capital budgeting question. Let us solve it. I will not do it in slow detail. I'll do it fairly fast because there is already a solution available in RTP. So my goal will not be to explain every single line item. We'll move slightly fast. Okay. First, this is a solution. Question 3, advanced capital budgeting decisions. If you see this, these are the steps. First, you have step 1 in replacement decision, net cash flow. Which is cost of new machine minus tax saving plus market value of old machine. This is one. This basically is you compute the net cash flow initially, net initial cash outflow. Then cash flow per year. That is what is the change in sales, change in cost, what is net of tax. Then you change in depreciation and all of that. Third, you compute present value of whatever is there in step 2. Then fourth, you take step 1 plus step 3. That is basically what is the net cash flow. It is inflow or outflow, and present value of outflows or inflows, whatever is there in step 3. So they see if they have given certain inflows, you will consider inflows. If they have given outflows, you will consider outflows. So whatever it is, you basically are looking at cost versus saving, or basically what you are looking at is your immediate cash flow, one set, plus yearly cash flows, another set. Okay. Step 1. What do we do in step 1? Net initial cash flow. What is the initial cash flow here? What is the initial cash flow? The purchase price of new machine. So outflow minus 26 lakhs. Then you have expenses of 9,000 installation, 6,000 for consultant. So do you capitalize that? Actually, if you honestly look at this, right, it looks like a sunk cost. But what happens is you are in this scenario, it is not a decision where it is not purely a cash flow decision. This is also a decision with respect to capitalization. Can you capitalize it? Yes, you can definitely capitalize it. Just because it is sunk cost doesn't mean it cannot be capitalized. From a cash flow perspective, you will not take that. So that is what they are doing. Installation minus 6,000, 9,000. What is this number? Minus 9,000. Consultant minus 6,000. Okay. Then you also have additional working capital. So this can also be added as initial outflow. Okay. Working capital minus 17,000. If you add all of these, 26 plus 15 plus 32. So minus 26 lakhs 32,000. This is the initial cash outflow. Okay. Then inflow. What is inflow? Book value of machine. Book value, how much did they give? Written down value of existing is 76,000. Then they said salvage value is 12,500. Sale value 12,500. Then they also gave something. What is it? The dismantling cost is how much? 4,500. Dismantling 4,500. So you see, this is salvage value is positive, dismantling is negative. So, and book value is 76,000. So if you see, look at this, the difference between these two, cash inflow, right, is 8,000. Now, if this is 8,000, book value is 76,000. What is the loss? Loss on sale is 68,000. So tax benefit on this, on loss. At what rate? They gave some rate, no, 35%. At 35%. So 68,000 into 35% is 23,800. So so this plus 23,800. Add inflow 8,000. So net inflow is 23,800 plus 8,000, which is 31,800. Now this is one outflow. This is one inflow and this is outflow. Net initial cash outflow and we have inflow, both are there. Then yearly cash flow. What is yearly cash flow? You have new money, how much is coming in? 8 line, we'll figure the depreciation, that will come later. But first, what is the other thing? The annual earnings from the new machine would amount to 3,15,000 income, but after depreciation. So, earnings after depreciation, 3,15,000. What is depreciation? Depreciation is your initial amount. Is depreciation charged including working capital? No. Depreciation is charged only on these three. So, which is why this 17, if you write separately also, it is good only. So, 9 plus 6 is 15, 26,15,000 is purchase price. So, depreciation 26,15,000 divided by 8. You get 3,26,875. Right. So, what is earnings after tax? 315 minus 35%. 315,000 into 0.35 minus is equal to 204,750. Add depreciation 326,875. That makes it 531,625. So this is cash flow is this much. Now this is for how many years? For year 1 to 8. 1 to 8. So present value factors, they've given something. Present value at 13% for present value interest factor is at 13% for 8th year is 0.376 and all 8 years is 4.8. So NPV, initial cash outflow, initial cash inflow, year 0, 0, then initial cash outflow is how much? 26,32,000. Initial cash inflow is how much? 31,800. Then yearly cash flow, year 1 to 8 is 531,625 into, what is the number they gave? 4.8. Okay. Then terminal cash flow. What is the terminal cash flow? You invested initially 17,000. You are going to get back that 17,000 of what? Working capital. So year 8, which is 17,000 into 0.376. So this is positive, this is positive. Okay, if you do all of this, what is the net number? 531,625 into 4.8 is equal to M plus 25,51,800. 17,000 into 0.376 is equal to M plus 6392 plus 31,800 and minus 26,32,000. So 31,800 M plus 26,32,000 M minus. What is memory recall? You get minus 42,008. You get minus 42,008. So since NPV is negative, do not replace. That is the answer. Okay. Next, security valuation. This is a very simple question actually. Somebody has surplus cash of 100 lakhs. They want to distribute 27% of it. So 100 lakhs में 27% is 27 lakhs. Okay, the company decides to buy back the shares. The finance manager of the company estimated the share price after repurchase 10% above the buyback price. Buyback price be P, post buyback it will be 1.1 P. Number of shares outstanding is share count is equal to 10 lakhs. EPS is equal to 3. You are required to suggest at which price, here therefore at which price the shares can be repurchased. The market capitalization of the company should be 210 lakhs after buyback. So I'll actually keep the question open here. Okay. And the number of shares that can be repurchased, Then the number of shares that can be repurchased, the impact of share repurchase on EPS, assuming after buyback net income shall remain the same. So this is a very simple question. We have solved it in class. I will solve it in 2 minutes. Okay, will not take too much time. I'll actually keep the question open here so that I can actually see and solve it much faster. So this is what? This is question number 4, right? Surplus cash 27 lakhs. Then company decides to buy back, financial manager decides that the price of the share, let pre-buyback price is equal to P, post-buyback price is equal to 1.1 P, then the buyback is the number of shares outstanding, current outstanding shares is equal to 10 lakhs, current EPS is equal to 3, implies current PAT is equal to 30 lakhs, simply multiplication of these two. Okay, then the required to such the price at which shares can be repurchased. The market cap of the company should be 210 after buyback. Post buyback market cap is equal to 210 lakhs, that is 1.1 P into, that is post buyback price, into shares that are into 10 minus X, let X be shares bought back, okay, is equal to 210 lakhs. Okay, now what is X? X is equal to 27. What is the surplus cash you have? X is equal to shares bought back. X is equal to total money spent by buyback price, that is equal to 27 lakhs is the money you have surplus by buyback price. Buyback price is P. Now pre-buyback price or buyback price is equal to P. It's not pre-buyback, this is buyback price. Buyback price is equal to P. So 27 lakhs is equal to PX. Okay, and here we have another equation, 1.1 P into 10 minus 1.1 PX is equal to 210, or 11 P minus 1.1 PX is equal to 210, and PX is equal to 27 lakhs. 1.11 P minus 1.1 into 27 lakhs is equal to 210 lakhs. This is lakhs. Okay, so 11P minus 29.7 lakhs is equal to 210 lakhs, or 11P is equal to 239.7 lakhs. So here also, and please note, this is not, both of them are lakhs only. Okay. And please note, both of them are lakhs. This 11 lakh P and 239.7 lakhs, because here we have multiplied with 10 lakhs. So this becomes 11 lakh P, 11 lakh P, 11 lakh P. Okay. So 239.7 divided by 11 is equal to P is equal to 21.79. Okay, 09. So I will take 791. Then what did they say? PX. PX is equal to 27 lakhs. P is equal to 21.791, implies X is equal to 27 lakhs by 21.791. That is, X is equal to 123,905, 904.88. I'll round it off, 905. So this is shares bought back. Now what are the questions that they asked? Price at which shares can be repurchased, that we already found out. How much? 21.79. Then the number of shares that can be repurchased, that also we found out, 1,23,905. Okay. Then the impact of share repurchase in the EPS, assuming after buyback net income shall remain same. So revised share count is equal to 10 lakhs minus 123,905. Equal to 8,76,095. PAT is equal to same 3 rupees and 10 lakhs. So that is 30 lakhs. We already noted it down here. current PAT 30 lakhs, and they said PAT is not changing. So revised EPS is equal to 30 lakhs divided by 876,095. That is equal to rupees 3.424. EPS increased by rupees 0.424 or 14.14%. Okay, so this is the way it has increased. Let us move to the next question. What is the next question? Hypothetical company issued a 10-year debenture of duration of 10 years. So see, they should be very careful. Is it duration? Is it tenure? Is it what duration? What is it? And it's currently trading at 850 per debenture. The bond is convertible into 50 shares, being currently quoted at 17 per share. That is convertible. 50 into 17 is again 850, and it is also trading at 850. Very good. If an equivalent comparable bond is at 11.8, then determine the spread of the yield on the above bond from this comparable bond. So they're asking what is the yield of this security which is trading at 850, which has a duration. Now they said duration. Okay, are they really meaning Macaulay duration, or they are actually meaning the tenure of the bond? See, here they have given for 10 years, boss. If you have given periods for 10 years, how can you call it duration? You have to call it tenure. This is unpardonable. This is a sin by the institute. You cannot call it as duration. Duration is basically Macaulay duration, which is weighted average maturity. Here this is not maturity. No, this is actual maturity. This is not weighted average maturity. This is actual tenure or actual maturity. Okay, they have given present value table, so on and so forth. Anything else? Nothing. So this is question number 5. So what is the current market price? Current market price is equal to 850. What is conversion value? Conversion value is equal to 17 into 50, that is equal to 850. Both of them are same. So both are same. Then they are saying find out YTM is equal to question mark. When price is equal to 850 and they have given two present value factors, right? What are the two factors that they have actually given here? I think they have given 11% and they have given 13%. So present value of, it is a what? 10% coupon, no? 10% of face value 1000. Present value of, or present value factor. Present value factor, present value interest factor annuity, that is for next 10 years at 11% for 10 years into this. What are the next cash flows that are actually going to come every year? 10% on 1000, that is 100, plus present value interest factor at 11% for 10th year into 1000. 850 is equal to this. Okay, is it or not? So 850 is equal to present value interest factor for 11 years. So they have given 11 years ka number. They have not given total. 1 by 1.11 is equal to 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. 0.352. If I do GT, I'll get 5.889. 5.889 into 100 plus last year is 0.352. 0.352 into 1000. So 850 is equal to 588.9 plus 352. Let me not do this as equal to 850. So price, let me call this as price at 11% yield. So price is equal to 588.9 plus 352 is 940. 940 at 11% YTM. At 13% YTM, P is equal to 1 by 1.13. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. 0.294. They gave 0.295, so we'll take that only. Is equal to, and I'll do GT. 5.426 into 100 plus 0.295 into 1000. That is equal to into 100 plus 295. 837.62. So yield is somewhere in between. Why? Because the price is 850. So at YTM and price, YTM of 11%, price is 940, YTM of 13%, price is 837.62. This is 940 or 939, 940.9, 940.90. Right. Now for a 2% increase, the price changes how much? 940.90 minus 837.62. 103.3. We want how much? We want for 850 minus 837.62, that is 12.38. So 12.38 divided by 103.3 into 2%, right? So 12.38 divided by 103.3 into 2, that is equal to 0.2396%. So at 13% it is 837. So at 14% it will come down further, but we need it to go up. If you have to go up, so it has to be reduced from 13. So 13% minus 0.2396%, that is equal to 12.7604%. So 12.7604. Now, is this the question? Have they asked us what is the YTM? No, you have to be very, very careful. What did they ask? The yield on equivalent bond is then determined the spread of the yield above the bond from this comparable bond. So, our bond is 12.76. The comparable bond is 11.980. So, what is the spread? Spread is 11.80 minus 12.96. That is 0.96% or 96 bips. If you don't write this, you lose marks. If you solve everything and don't write this, you lose marks. Spread over comparable bond is equal to 12.76 minus 11.8, that's equal to 96 bips. Okay, this is done. Next, business valuation. STR current financial income statement report is net income after taxes 50 crores. After tax net income. Following is the capital structure of STR at the end of the current financial year. Debt is 80, equity is 250, invested capital is 330. Okay, no problem. Following data is given. Asset beta is 1.11, risk-free rate, market risk premium. Applicable corporate tax rate is 30, estimated economic value. So you estimate the economic value at EVA. EVA is equal to NOPAT minus WACC into invested capital. So what is NOPAT? NOPAT is EBIT into 1 minus tax minus WACC into invested capital. So what is EBIT here? Have they given EBIT income, net income after tax? PAT is 50. PAT is 50 crores. So what is tax rate? Tax rate is 30%. So PBT is equal to 50 by 70%. That is 15 divided by 0.7. That is equal to 71 crores 42 lakh 85,714.28. Okay. Then interest. Interest is 11% on 80 crores. That is equal to 80 into 11%, that is 8 crores 80 lakhs. Total is, so EBIT will be summation of these two, 71 crores 42 lakh 85,714.28 plus 8 crore 80 lakhs will be 80 crores 22 lakh 85,714.28. This is EBIT. Now EBIT into 1 minus tax rate is 1 minus 30%. So into 0.7, you will get 56 crores 15 lakh 99,910. So I can take 56 crores 16 lakhs. Okay, this is EBIT into 1 minus tax rate. This is basically NOPAT. Okay, now what is cost of capital? Is invested capital is equal to 250 crores plus 80 crores that is 330 crores. WAC is working note. Okay, working note. What is cost of equity? Cost of equity is equal to RF plus beta into MRP. Now beta of asset is equal to 1.11. Beta of asset is equal to beta of equity into equity by equity plus debt into 1 minus t. Beta of debt is equal to 0. That because I have not given anything, we are going to assume beta of debt as 0. So 1.11 is equal to beta of equity. Here this is equity, okay, into equity by 250 by 250 plus 80 into 1 minus 30%. So 80 into 0.7, 56. So 1.11 into 306 by 250 is equal to beta of equity, or beta of equity is equal to 1.11 into 306 by 250. 1.35864. This is beta of equity. So cost of equity is equal to risk-free rate of 8.5 plus 1.35864 into risk premium they gave directly of 9% into 9 is equal to plus 8.5. Cost of equity is equal to 20.72776%. WAC is equal to 250 by 330 into 20.72776 plus your 11% is cost of debt into 1 minus 30% is post-tax. Here you have to do again post-tax, don't forget that, into 80 by 330. So 20.72776 into 250 by 330 is equal to M plus 11% into 0.3, 11 into 0.7 is 7.7 into 80 by 330 is equal to 1.8666 M plus. If you do memory recall, WAC is equal to 17.5695%. Here we have WAC. This is done. Now cost of invested capital 17.5695. So cost of invested capital is equal to 17.5965, not 5695, not 5965. 5695% into 330 crores to 330. That is equal to 57 crore 97 lakh 94,000. Okay, so EVA, what is EVA? EVA, this is 2, 1 minus 2. NOPAT is 56 lakh 16,000, right? Sorry, 56 crore 16 lakhs minus 57 crore 97 lakh 94,000. Please be very careful with all these numbers. 56 crore 16 lakhs minus 57 crore 97 lakh. See, again I only made a mistake. 97 lakh 94,000. 94,000. Let's go to minus 1 crore 81 lakh 94,000. 1 crore 81 lakh 94,000. If you round off these numbers, okay, so WAC, if you round off slightly, then you round off some of these numbers, you'll probably get a slightly different answer, but that should be okay because you're giving more decimals. It should not ideally be a problem. Okay, this is done. Then next question was, what is next question? On April 15, 2015, Sunidhi was holding a portfolio of 10 securities whose values was 9,94,450. Weighted average beta of 9 securities was 1.1. She was weighted average of 9 was 1.1. Very good. She was expecting a fall in price of the shares in near future to hedge her portfolio. She sold 5 nifty contracts of future, multiplier of 5, expiring in May, which was trading at so and so on 1st April. Calculate beta of the 10th security. Reconcile the reasons. In spite of 2% fall in market, as per Sunidhi's definition, would have earned some profit on her cash position. So this is a slightly reverse question. What is this? What is our portfolio value? Portfolio value is equal to 9,94,450. Okay. Beta of portfolio we don't know. Okay. Now she said to hedge her portfolio. So to fully hedge, portfolio hedge, they did what? He sold 5 Nifty into 25 into 8767.07. So she sold this much to hedge it fully. That means portfolio value into portfolio beta is equal to Nifty futures into Nifty beta. Right? That is when your beta, this beta, that beta will cancel out, or this is positive, this is negative, both of them will cancel out because you have done both together. So 9,94,450 into beta of portfolio is equal to beta of Nifty is 1 into 5 into 25 into 8767.07, or beta of portfolio is equal to 5 into 25 into 8767.07 divided by 9,94,450. Beta of portfolio is 1.1019. So we can take it as beta of portfolio as 1.102. Now beta of 9 securities is equal to 1 point. How much did they give? 1.1. Now, did they say what is the weighting of each of these securities? See, it is a very, very bad question that way. The weighted average beta of 9 securities of the portfolio. Okay, so we don't know whether each of those security was equal weight or different weight. See, we know the beta of the 10th security. We know the beta of 9 securities. We know the beta of all 10. We don't know the weight of those 9. See, that's a bad question, right? So, because they should ideally have given that also. Beta weight. Assume each security is 10%. Then 90% into 1.1 plus 10% into beta of 10th security is equal to 1.102. Okay, so you have to assume that all securities are equally weighted, okay, in terms of value, not in terms of beta. So 0.9 into 1.1 is equal to 0.99, 0.99 plus, or I'll write it like this, 1.102 minus 0.99 is equal to 0.1 beta 10th security. So 1.102 minus 0.99 is equal to 0.112, 0.112 is equal to 0.1 of beta of 10. So beta of 10th security is equal to 0.112 by 0.1. That is equal to 1.12. Now what is the question that he asked? Calculate the beta of the security. Done. Reconcile the reasons that in spite of 10% fall in the market as per Sunit's apprehension, you should have earned some profit on her cash position. What is that cash position? Cash position means the portfolio that she has is called as cash position. If even though there is a fall in market of 2%, she would have earned some profit on her cash position. What could be the reason? See, you have some stocks. You sold a Nifty. Now, if the market falls, what will happen? Your portfolio value will fall. Because you have sold the Nifty, because you're short Nifty, you will make a gain. These both will cancel out. Now what are they saying? You have made a gain here. But here, this did not fall. This was slightly better, or the net impact is not 0. So the net impact would not be 0 if, see, on futures, nothing, you can't change anything. If Nifty falls by 2%, the futures will also fall by 2. Because you have shorted futures, you'll make a gain of 2. But even though you have made a gain of 2, you're ideally supposed to lose that 2% in the portfolio. You have not lost the 2% in portfolio. You've lost either less or you made a gain. Why? Because one of the securities did not fall, or the portfolio did not fall as expected. The portfolio or securities did not fall as expected. Hence, on cash position, she made a profit. Right. So ideally they were supposed to go down by 2. Did not go down by 2. Right. The portfolio did not fall as expected, and hence on cash position she made a profit. Okay. This is done. This is 7.1. Inside that 1 and 2. Now there is 7.2. What is 7.2? A futures contract is available in R Limited that pays an annual dividend of 4 and whose stock is currently priced at 125. Each futures contract calls for delivery of 1000 shares of the stock in 1 year, daily marking to market. Treasury bill rate is 8%. Given the above information, this is the price of one futures contract. If the company stock price decreases by 6%, what will be the price of one futures contract? Suppose the company stock price decreases, then evaluate realized gain or loss for investors that has long position. Okay. Stock current price is 125. This is 72, right? Current market price equal to 125, then dividend is equal to 4, then future contract calls for delivery of 1000 shares to stock in 1 year, daily marking to market, T-bill rate is 8%, R is equal to 8%, then given the information, assess the price of one futures contract per share, futures contract lot size is equal to 1000, futures price per share is equal to 125, future value of this minus futures price per share is your spot plus cost of carry minus dividend, and in this I have told you it is spot minus present value of dividend whole thing future value. This is what can be equated to. So here what did they say? That pays an annual dividend of 4. So we don't know when the dividend is paid. So we have to assume that the dividend is paid on the last day. That is, so we have to assume that the dividend is paid on the last day. If you pay dividend on last day, you will do present value for till today, and then again you will do future value till then. So there is no impact of that. So all you will do is future value of spot minus dividend. That is 125 into, and have they given which method to use in terms of compounding, discrete, continuous, nothing. So into 1.08 minus 4, that will be, this will be I think 10 rupees. So 135 minus 4, I think this will be 131. 125 into 1.08. Yeah, 135 minus 4, 131. So the futures price is 131. Now futures price is 131, contract is not 131. Future contract price is equal to 131 into 1000. That is 1,31,000. That is 1,31,000. Next, what is the next point that they have said? Given the assess the price of one futures contract, the company stock price decreases by 6%. What will be the price of one futures contract? If stock price decreases by 6%, then spot will be 125 minus 6%, that is equal to into 0.94, 117.5. Future is equal to 117.5 into 1.08 minus 4. That is equal to 122.9. So futures contract price is equal to 122.9 into 1000, that is 1,22,900. What is the third question, boss? Suppose company stock decreases, then evaluate realized gain or loss from investors that result in a long position in one futures contract. Decreases to what? What horrible question is this? No, English is poor, what they want to ask is poor. Anyway, company stock price decreases. See, what have you done? Futures contract is given the information, the company stock price decreases. Futures contract is available. They are saying, then evaluate the realized gain or loss for investor that has a long position on futures. So if you have a long position on futures, if you are long on future, what happens? Long future. Okay, meaning if the rate goes up, you will gain. Short futures means if the rate comes down, you will gain. Long futures at what rate? At, I think this at 125. So at spot of 125, so future is 131. Price moves down by 6%. So futures price is equal to 122,900. So loss is equal to, you've agreed to buy, then you will sell it off in the market at 122,900, 131,000 minus 122,900, 8,100. 8,100. Okay. Let us move to the next question. What is the next question? Interest rate risk management. MPD issues. MPD issues a 50 million floating rate loan on 1st July 18 with the resetting of coupon rate every 6 months equal to L plus 50. First of all, LIBOR is not there. They themselves have told. I don't know why they are asking question on LIBOR. 50 million loan with every 6 months reset. Okay. They are interested in an interest rate collar strategy of selling a floor and buying a cap. So when they issue a loan, meaning they issued a security and they borrowed the loan. Okay, that is what is the understanding. They buy 3-year cap and sell 3-year floor as per the following details. Principal amount 50 million, strike rate 5% for floor and 8% for cap, 6 months LIBOR, premium nil. Since premium paid for cap is premium receipt for floor, with zero cost collar. The reset dates per annum and the interest rates thereon are on 31/12. See, for on 1st July 18, already the first installment or the first interest service amount of whatever that LIBOR plus 50 bips, the LIBOR has already been set. So, from July till December, whatever is the LIBOR doesn't matter, because on 1st July, what is the LIBOR? That is the interest that is paid on 31st December. Whereas 31st December, whatever is the LIBOR, that is paid for the next installment. So, it is a 3-year. 3-year meaning when made they enter on 1st July. So, July 18. July 18 to July 19, July 19 to July 20, July 20 to July 21. So, it should end on July 21. So, what are the relevant? July 21 is the date when the loan ends. Okay. You bought a 3-year cap and 3-year floor. So, basically, July 21 is when the loan ends. Or is that the case? Let me see. Let us see. Have they given any other information? You are required to determine effective interest paid on each 6 days, round off the decimal, average effective interest rate, round off 2 decimals, assume 365 days a year and 360 days for leap year. Okay, so that leap year one all we'll see, average rate also we'll see. So, I don't think they've given the tenure of the loan. See, they have not mentioned tenure of the loan. So, basically what they're saying is 3 years from today. So, whatever interest rate setting happens over these 3 years, those are all covered. I think that is what is the meaning. That is why they have given 6 periods. Okay, then what are we supposed to do? What are the things we are supposed to do? Effective interest rate paid out each 6 of the dates, round of the nearest rupee, effective average overall interest rate of interest per annum. Okay, assume 365, 366 days. This is what? This is question number 8. Okay, I'll keep the question open here. This one, what is it? Year, date, LIBOR, cap, payoff, floor payoff, net interest. Okay, so we have on 31/12/18. Then what are the dates? 36/19, 31/12/19, 36/20, 31/12/20, 36/21. 1, 2, 3. They gave 6 periods, right? 21. What is LIBOR? LIBOR is 7, 8, 6, 4.75, 4.25, 5.25. Now cap is at what? Cap is at 5 and floor is at 8. So, and see, basically what have they done? They have purchased a cap and sold a floor. So, if the level goes below 5 and 8 only, no, or 8 and 5, I think I wrote ulta. That is why you have to be very careful. 5 for floor and 8 for cap. That is what I was thinking. Why did I write ulta? Okay. If it goes below cap payoff and floor payoff is 5. So, if it goes below 5, these guys have to pay somebody. If it goes above 8, somebody will pay them. Okay. So, cap payoff, has it gone above 8? No. This is also cap payoff also, no. So, there is actually no cap payoff, please note. Whereas there is floor payoff that these guys have to pay somebody. There is nothing here. Here you have to pay for 25 bips. Here you have to pay for 75 bips. Here there is no payoff. So, what is your interest? The interest cost for these guys, LIBOR plus 50 plus, if there is any floor payoff plus floor minus cap payoff. So, this is the interest. What is the interest rate here? Here 70 plus 50, 7.5%. 8 plus 8.5. This is 6.5. This is LIBOR is 4.75, but you have a floor payoff that you are going to make of 0.25. So, it is 5.5. 5.75 plus 4.75 plus 0.25 is 5 plus your spread of 50 bips. then here 5.5, then this is 5.25. This is the net interest payoff. Now they are actually asking what? They asked for what? And it is 50 million rupees, please be careful. 50 million rupees. As for effective interest rate paid out at each reset date, round off to the nearest rupee. Okay, so now this 3112, that is the interest date. So if this is the interest reset date, when is the interest paid off? Interest is paid off on 30th June 19. See, interest is set today, meaning that interest is applicable for next 6 months. So the interest is paid off after 6 months. So you have to take the number of days up for next 6 months. So 31/12/18 to 36/19. How many days are there? And please note here, they have said if it is leap year, consider leap year, otherwise consider 365. So now in this first period, how many days are there? You have whatever interest rate is there on 31st, it is applicable from 1st. So 31 plus 28 plus 31 plus 30 plus 31 plus 30. So it is 181 days. So it is 181 days. For this 181 days, you pay 7.5% into 50 million crore. What did they say? 50 million rupees into 50 million rupees. 50 into 7.5% into 181 divided by 365. The interest that you will pay is 1859,589.04. Okay, did they say rounding of 2 decimal? I think they said rounding of about 2 decimal. No, where is this? Effective interest round off the rupee. Acha, okay. But interest rate they said round off to 2 decimal. So I need not round it off here. 204,589. 1 crore 85 lakhs 95,000. Sorry, 18 lakhs 59,589. Correct. Okay. Then 3619 to 311219. See, earlier you took 181, so obviously there has to be 184. Why? Because out of 360, 181 is already done, right? So here what is the rate? 8.5. So 8.5% into 50 into 184 by 365. 50 million into 8.5% into 184 divided by 365. You get 2142466. 2142466. Then 311219 to 3620. So in this year you will have 20 is a leap year, so you will have 1 day extra. So this will be 182 days. So and this rate is what? 6.5. So 6.5% into 50 into 182 by 366. 50 million into 182 by 366 into 6.5%. You will get 16 lakh 16,120. Okay, see the volatility. Okay, then 3620 to 311220. This will be 184 days, and this rate is what? 5.5. Into 184 by 366. One 382513 or one you can take 14. Okay, then 311220 to 3621. How many years? 1 2 3 4 5. We have to do 2 more. Okay, this will be 181 days, and this is what? 5.5. Say it is also again 5.5. So 5.5 into 50 into 181 divided by 365. So everything will change. So 50 million into 5.5% into 181 divided by 365. It gives you 13,636,99. Then 3621 to 311221 have 184 days, and this is what? 5.25% at 5.25%. to 5.25%. Is this 5.25 only? Yes, 5.25. No, it should not be 5.25. No, it should be 5.75. See, I made a mistake. Should be very careful, guys. This is not 5.25. This is 5.75. How did I figure it? When I was going through everything, I saw ki 6 plus half 6.5. But here 5.25 plus 5.50, 5.75. So please be very careful. So into 5.75. Correct. So 50 million into 5.75% into 184 divided by 365. 1449315. So these are the payments. Now what is the other question that they asked? Next question that they asked is effective interest paid out each rate. Overall effective rate of interest per annum rounded off to 2 decimals. Now what do you mean by overall effective rate of interest per annum? Is it per year what is the interest that is paid, or altogether basis what is paid? So I actually think it is altogether what is paid. What is altogether? Total interest. 1859589 plus 2142466 plus 1616120 plus 1382514 plus 1363699 plus 1449315 9813703. This is paid on how much? 50 million. For how many years? 3 years. Now there are 3 years, but 1 year is a leap year. So 365 into 3 plus 1, basically 1096 into 365 by 1096. That is equal to 6.536. So I will take 6.54%. So we will take 6.54%. This is the answer. Okay. We have done this. Next, NK has categorized all available stock into 2 types: large cap, small cap, large cap growth. This is that arbitrage pricing theory question. Yeah. So Mr. NK, this is there in the material. Also, NK has estimated the weights of the above categories in the market index. Further, sensitivity of returns of these categories of stock of 3 important factors are estimated below. So weight in market index, factor 1 is beta. Here when they refer to beta, they are referring to beta with respect to market returns. Factor 2 book price, factor 3 inflation. Rate on treasury bonds is 4.5. Using arbitrage pricing, determine the expected return on the market index. Using CAPM, determine the expected return on market index. He wants to construct a portfolio using only the small cap value and large cap growth stocks. If the target beta of the desired portfolio is 1, such a composition of his portfolio. So this is the arbitrage pricing theory question. Now what is it? Using determine the expected return on the market index. Market index means they are saying what is going to be the return of the market. So return of the market is what? See, you have anyway split the market into 4 parts. So if you take the weighted average return of each of them, you will get it. Now what is the return of each of them? See, you have risk free as 4.5. You have 4 betas. Okay, and for each one of them you have a risk premium. So you just multiply respective beta with risk premium, you will get the answer. So it is APT return small cap. What is this first one? Small cap growth is equal to RF plus beta 1 lambda 1 plus beta 2 lambda 2 plus beta 3 lambda 3. That is what they are asking. Now what is RF? 4.5%. No, they have given 4.5% plus what is the first beta? I will keep it open here. It is easier for me that way. What is beta here? 0.8 into risk premium 6.85% plus 1.39 into minus 3.5% plus 1.35 into 0.65%. That will be 4.5% M plus 4.5 M plus 6.85 into 0.8 is equal to M plus, and this is minus, no? So 1.39 into 3.5 is equal to M minus, 1.35 into 0.65 is equal to M plus. If you do memory recall, to 5.9925%. Same way, return small cap value, right? Next one is value. 4.5 plus 0.9 into 6.85 plus 0.75 into minus 3.5 plus 1.25 into 0.65. That will be 4.5 M plus 0.9 into 6.85 is equal to 0.9 into 6.85 is equal to M plus 0.75 into 3.5 is equal to M minus 1.25 into 0.65 is equal to m plus. Memory recall 8.8525. Then large cap growth is equal to 4.5 plus 1.165 into 6.85 plus 2.75 into minus 3.5 plus 8.65 into 0.65. 1.165 into 6.85 is equal to m plus. 2.75 into 3.5 is equal to m minus. 8.65 into 0.65 is equal to m plus. 4.5 m plus. Memory recall 8.4775. Then large cap value. Large cap value is 4.5 plus 0.85 into 6.85 plus 2.05 into minus 3.5 plus 0.6 is it? Plus 0.65 into 6.75. That will be 4.5 m plus 0.85 into 6.85 is equal to m plus. 2.05 into 3.5 is equal to m minus. 0.65 into 6.75 is equal to m plus. Memory recall 7.535. Okay, now what do we have to do? Take weighted average of all of this. What are the weights? 0.25 into 5.9925 plus 0.1 into 8.8525 plus 0.5 into 8.4775 plus 0.15 into 7.535. So this will give us 0.25 into 5.9925 is equal to m plus. 0.1 into 8.8525 is equal to m plus. 0.5 into 8.4775 is equal to m plus. 0.15 into 7.535 is equal to m plus. Memory recall, you get 7.7525%. This is APT, expected return of the market. Correct. Next, what is it? Using arbitrage, determine expected return of the market index. Then using CAPM, determine expected return of the market index. Now, what is CAPM? CAPM is simply your beta. So, same exercise what you did, you do it now excluding these two other factors. What are these? How do you do this? And see, they have given already the risk-free rate. Now, risk-free rate is given. But what is a market risk premium? That market risk premium also they have already directly given. So, you can directly do this as this, because risk-free beta into MRP. Same thing here, and same thing here. We have already done that. So just let me note that. Let me note down those numbers. Return market, small cap growth, small cap value, large cap growth, large cap value. Percentage is or weight percentages. How much? 0.25, 0.1, 0.5, 0.15. And what are these numbers? 0.9 into 6.85 is equal to 6.165 plus 4.5 is equal to 10.665. 10.665 into 0.25 is equal to m plus. Then this is done, first one. Then we come to the second one. 0.9 into 6.85 is equal to 6.165 plus 4.5 is equal to 10.665. No, I think I did first one as 10.665. 10.665. 10.665 into 0.1 is equal to m plus. Then the first one is 0.8 into 6.85 is equal to 5.48 plus 4.5 is equal to 9.98 into 0.25 is equal to m plus. Then first two are done. 6.85 into 1.165 is equal to 7.98 plus 4.5 is equal to 12.40 48025 into 0.5 is equal to m plus. Then last one, 0.85 into 6.85 is equal to plus 4.5 is equal to 10.3225 into 0.15 is equal to m plus. So weighted average expected return on the market is equal to, memory recall, 11.35%. This is also done. Then what is the third question? Using CAPM, determine. NK wants to construct a portfolio consisting only small cap value and large cap growth. If target beta for the desired portfolio is 1, suggest the composition of this portfolio. See, target beta. So when you are referring to here beta, you are referring to the market beta. So what is the small cap? What did he say? Small cap value. I'm opening the same question here, reading it because it is easier. Small cap value plus large cap growth, beta is equal to 1. So small cap value weight is equal to x. Then x into, what is the beta of small cap value? Beta of small cap value is 0.9. Here when they are saying beta, we are referring to beta of the stock returns on market returns, plus 1 minus x, because 100% is the total weight. Out of that, x is already taken out, into large cap growth. Large cap growth is 1.165 is equal to 1. The weighted average of these two is 1. That is what they are basically asking. Find out what is the weight. Correct? No. That's what they said. What did they say? NK wants to construct a portfolio using only small cap value and large cap growth. If target beta for the desired portfolio is 1, such is the composition of this portfolio. Basically asking you the weights. So 0.9x plus 1.165 minus 1.165x is equal to 1, or 1.16, it is 1165 165 1.165 minus 1 is equal to 1.165x minus 0.9. That is 0.165 is equal to 0.265x. X is equal to 0.265 by 0.165, which is equal to it is 1. Ulta. That's what I was wondering. Kuch to gadabad hai. Something is wrong. X is equal to 0.165 by 0.265. 0.165 by 0.265. See, you should not make all these mistakes like what I just now did. 62.26%. So small cap value, right? Small cap value is equal to 62.26%. Large cap growth is equal to 37.74%. See, I have written in short form. In exam, if you write short form, you will not get marks. Please note, I am solving it quickly. The goal is to solve quickly and get the essence, not to do it in a 100% detailed exam-oriented manner. Okay, this is done. Okay, this is done. Now, let us move to the next question. What is the next question by Forex? Interesting. On 1st October 24, an exporter enters into forward contract with the bank to sell $1 lakh on 31st December 24. Okay, after 3 months at USD INR 85.4. Okay, however, the request of the importer, G received the amount on 30th November, so he got it early delivery. Okay, Mr. G requested the bank to take delivery on the remittance on 30th November before the due date. The interbank rate on 30th November was as follows: 85.22 by 85.27. 1 month premium is 10 or 15. 10 by 15, bid ask basically. And if bank agrees to take early delivery, what will be the net inflow to Mr. G? And if Mr. G can deploy these funds in USD and earn a return of 3% per annum, then advise which option would be better, deliver to the bank or investment in USD. So what is he saying? And also note, assume 365 days in a year, assume prime lending rate is 18%, term deposit rate is 12%, round of calculation to 2 days month. See, we'll see all of that. Now in this is early delivery. Very clearly the question is early delivery. Now, if you remember the early delivery wala concept, in early delivery, see, there are 3 things. Well, just open the thing. So, if you're taking early delivery, what is the thing? The charges will be swap charges plus interest. What is swap? On the due date or on the date on which the customer action takes place, you enter into a buy and sell. One will be spot, one will be forward. The difference between those two, if it is a loss, that has to be reimbursed by the customer. Interest is where whatever is the, because of the funds flow, whatever is the loss to the bank, that has to be reimbursed. So the only charges that will be applicable here will be swap and interest charges. Okay, this is what you have to remember. Now coming back, early delivery. Early delivery, what is the thing? I'll open it here, boss. Very difficult to keep scrolling up and down. So customer, bank, is there any back-to-back rate? No back-to-back rate is given, nothing is detailed. So original transaction 110, sell USD 100,000 at 85.4 on 3112, buy USD 100,000 at 85.4 on 3112. They will enter into a back-to-back. We are not aware of back-to-back. Okay. Now on 30th November, early delivery. So he wants to now sell USD 100,000 at 85.4 on 3011. So he's doing in advance. So what will this do? This guy do, he will buy off USD 100,000 at 85.4 on 3011. So he will honor the transaction. But then there are some other transactions. What are these other transactions? See, first of all, the bank is buying off well before the due date. Where will, if he buys, what will he do? He will sell in the market. So he will sell USD 100,000 at what rate? When bank is in the market. And see, they have not even told what is the charges, kuch nahi. Whether there is any rounding off, 25 bips, is there any margin, nothing is given. If nothing is given, don't take anything. It's a simple logic. Don't overcomplicate things which are not given. At least rounding off you can do, but how will you take margin without knowing what is the margin percentage? Correct, no? So you will sell them in the market. What are the two rates that are there in the market on that day? On that day, 85.22 and 85.27. Now, because this guy is now, bank is in wearing the customer shoes, when he sells, the rate that will be applicable will not be asked, it will be bid. So he will sell in the market at 85 point, what is that? 22. What is that? 85.22. Okay. This is one action. Whatever he got, he sold off. Now, he entered into a back-to-back to sell on 3112. See, there was a back-to-back that he would have entered on original date, on 110. Why? Because he is buying something from this fellow customer. He has to sell it off in the market. He can't keep any position open in his books. So he'll sell. He entered into back-to-back to sell. But he doesn't have anything to sell on that day. No? So what he will do is, he will now also buy USD 100,000, this is spot, he will buy it at forward. When he is buying, again he becomes the customer at 85.27. Why? The rate is 27 plus 15. See, when he is selling in the market, he will sell it lower rate. When he is buying in the market, he will buy at the higher rate. So he will buy at 85.42 after 1 month. All this transaction he does on 3011 only. Okay. Now what is happening? What are the two charges that we discussed? Swap plus interest. What is swap? There is a buy, there is a sell. Okay, there has to be a buy, there has to be a sell, there has to be a spot, there has to be a forward. Now what has happened here on the nuisance value date? On the nuisance value date, this is basically when the customer made a change, he has sold spot. So he has sold spot and he bought forward. So the difference between those two, right? The difference between these two, those are swap charges. So swap charges is equal to 85 and see, he bought at 42, sold at 22. Okay, so swap charges on 85.42 minus 85.22, that is 20 paisa into 100,000. 1 lakh into 0.2, that is equal to rupees 20,000. Okay, that is rupees 20,000 swap charges. Okay, that's why I'm putting it directly in number, positive number, not negative number, because charges are very clear. Charges. Okay. Then interest. What is interest? Interest is on outlay of funds. What is outlay of funds? What are the funds he has had to deploy, or he has had to pay, or there was a flow either early or late. So you see what happened. What has happened? And look at it in rupee terms. What has he had to do? He had to sell something in spot. Correct? He had to sell something in spot at 85.22. Ideally, he would have sold it off in the future date. So, from future, you brought it forward. And what is the fund flow? He is actually getting money. So, he sold some dollars, he is getting money. What is inflow? Inflow 85.22 into 100K is inflow. Now, what is outflow for this fellow? What is outflow for this fellow? Where is the money going, or where is he giving cash? Where is rupees going out from his hand? See, he has purchased the $1 lakh from him at 85.4, from the customer at 85.4. So, he's got dollars and he given rupees. So, he gave out rupees. So, his outflow is what? 85.4 into 1 lakh. So, what is the net difference? 18% to 1 lakh, which is 18,000 net outflow. So, on this outflow, interest at what percentage? They have given 2-3 rates, okay. They have given one interest, and this is for how many days, by the way. Days is what? 31st December to 30th November. Days 31. Interest is at what rate? They have given 2 rates. What are the 2 rates? One, I think they gave 18%, other one is 12%. Prevailing prime lending rate is 18%, term deposit rate is 12%. See, now this fellow, there is a net outflow. Basically, he is having to borrow. So, if he is, when I say he, I am referring to the bank. For bank, there is a net outflow, and the bank is now having to borrow this 18,000. For them, it is the 18,000 is a cost, additional outflow. So, interest will be charged at 18%. So, 18,000 into 18%, 3240 into 31 divided by 365. Okay, you can do it on monthly basis, you can do it on days basis also. Here they said assume 365 days in a year, so we are doing it on day basis. So you get 275. Now next, what is the question? 275.178 or something, and they said 2 decimals also. So please take 2 decimals. 275.18 rupees. So what is the specific question? Specific question was, what will be the net inflow to Mr. G? Net inflow to Mr. G is 85,40,000. 85,40,000 minus 20,000 swap minus 275.18 interest. So that is 85,40,000 minus 20,000 minus 275.18. 85,19,272 to 724. 724 point net inflow. Okay, this is the first part of the question. What is the second part of the question? Second part is that if he can deploy these funds in USD and earn a return of 3% per annum, advise which option will be better, deliver to the bank or investment. So basically what he's saying is, customer has got this $1 lakh. Don't give that $1 lakh to the bank. Just retain them. So 1 lakh, this is our 0.2, deposited at 3% for 1 month is what? 1 lakh into 3% into 31 by 365. You get 254.79. Okay, so 254.79. Now, what happens? See, you 1 lakh, whatever money you've got, you will get it after 31st, because you have kept the money with you and you're selling it to the bank after 1 month at 85.4. So 85.4 into 1 lakh plus 254.79. This, you are aware today itself that you place a deposit. So you will enter into a forward contract to sell it today itself. And what is today's rate? Today's spot is 85 point. So when you are selling, when I'm saying you, here the customer, okay, they're selling it at 85.22, and because bid is what it is, and plus 10 paisa, so 85.32 into 85.32. So 254.79 into 85.32 is equal to M plus 85.4 into 1 lakh is equal to M plus, memory recall, 85.4 into 1 lakh is equal to M plus 254 0.79 into 85.32 is equal to M plus memory recall 85 lakhs 61,738.68. Okay, this is one way. Now, if you don't deposit, but you have don't do a USD deposit, but do an INR deposit. That is, whatever money you got on 30th of November, you deposit it for 1 month. What is the deposit rate for 1 month? 12%. They gave term deposit rate as 12%. So 85, 19, 724.82 INR deposit. Okay, into 1 plus 12% into 31 by 365. Okay, 85, 19,724.82 into 12% into 31 divided by 365 is equal to plus 85, 19,724.82. You get 86 lakhs 65 6,555.98. So now which is better? INR deposit, that is conversion today, is better than USD deposit. Correct, no? You got 85 lakhs, that 85 lakhs 19,000, you deposit it at 12%, which that is better. Or you don't get 85 lakhs today, you get 85 lakhs after 1 month, but you get a 3% interest rate on the US dollar funds, you'll get 85 lakh 61,000 versus 86 lakh 6,000. So obviously INR deposit is better. So that is the answer. Okay, next, let us move to the next question. What is the next question? 11. XP Pharma has acquired an export order of 10 million for formulation from a European company. The company has also planned to import bulk drugs worth 5 million from a company in UK. So you have export of 10 million and import of 5 million. Okay. The proceeds of exports will be realized in 3 months from now, and proceeds of imports will be due after 6 months from now. The invoicing of these export imports can be done in any currency, that is dollar, euro, pound sterling, and company size. The following quotes are available. Spot rate, annualized premium, euro, dollar, rupee, euro, rupee, pound. Advise XP Pharma Limited in which currency invoicing for both import and export should be opted. Exchange rate include calculation should include up to 2 decimals. Okay, so this is what question number 11. So what is it specifically said? I'm opening it here and checking in. Export INR 10 million, import INR 5 million. This is to Europe. This is from UK, and the proceeds will be realized in 3 months. This is 3 months. This is 6 months. After 6 months, you'll pay. Okay. Then what is he saying? He's saying advise XP Pharma in which currency invoicing should be done. So now you can do export also in any currency, import also in any currency. So we have to do for all 3 currencies. What are the 3 currencies? Rupee dollar, rupee euro, rupee pound. So these rates, no, and they've also given annualized. Premium. So you have to take compute the forward rates and then take it. Okay. So the question is where is their least outflow and highest inflow? So first let us look at export. Export is 10 million in euro terms, 10 million in rupee terms. You can do it in whichever currency. So first we'll take dollar, then I'll take euro, then I'll take pound. Amount 10 million rupees, 10 million rupees, 10 million rupees. Now, what is the exchange rate? Exchange rate will be, this is inflow. Inflow means you'll always get the bid rate. Bid rate will be bid 87.1 is spot and 101.15 is spot and 116.65 is spot. What is premium? Premium is you have 7%. So 87.1 into 7% into 3 by 12. Total is what? 87.1 into 7% into 3 by 12 is 1.52 plus 87.1. So you get 88.62. Did I say anything decimals? 624. So I'll take 62. Then 101.15 into what is the interest rate? 6%. 6% into 3 by 12. 101.15 into 6% into 3 by 12. You get 102.67. Then 116.65 into what is the interest rate? 5%. 5% into 3 by 12 is equal to plus 116.65 is equal to 118.11. 118.11. So amount received. So this is the forward rate. This is the forward rate. This is the forward rate. Right. Now, this is the amount today. But if you are going to invoice it in spot, see, when you have an option to invoice in any currency. As on today, value is 10 million in rupee terms. This is rupee terms. So how will you invoice? See, if you're going to receive money in foreign currency, you obviously would have invoiced in the same currency, right? So what is the value at which you would have invoiced? 10 million divided by 87.1, which is 114,810.56, and you get the money at 88.62 into 88.62, you will get back 10174512.06. Okay, this is invoice, invoice, receive, receive. Okay, this is what you're going to get. Then 10 million by 101.15. You get 98863.07. You get it back at 102.67 into 102.67. So you get 10150,271.87. Then 10 million by 116.65. $85726.53 into 118.11. You get 1012516.07. Now, which is the highest in this? You are basically getting highest in this case. So you are invoicing initially in a currency, and then you're going to get the same in money in the same currency, which you're going to convert it to forward rate. So you're getting it at this one. This is the same way we do for imports, but in imports you'll do at the lowest. Imports. What is it? It is 5 million. No, exports is how much? Export is 10, import is 5 million. So 5 million dollar, euro, pound, 5 million. This one I'll do everything together only, boss. And here it is same interest rate, but it is for 6 months. Please don't forget. So 5 million divided by 5 million divided by what rate will you use? You will do it bid or ask. Here, because you are an importer, when you invoice, you will take the other rate. Because you are an importer, when you invoice also, you basically will invoice at the ask rate, because you are having to, when you invoice, you take, because at the end, you are going to pay the money. If you are going to pay the money, you are going to buy the dollars. If you are going to buy the dollar, bank is going to sell the dollars. So you will take always the ask rate. Okay. So 87.2, 101.2. 116.75. Okay. Now, what is invoice value? 5 million divided by 87.2 is equal to 57,339.45. 5 million divided by 101.2 is equal to 4940. 49407.11. 116.75 is equal to 42826.55. This invoice value. Then payment value. What is payment value? 87.2 plus what is the interest rate? 7%. No, 7% into 6 by 12. So 87.2 into 7% by 2 plus 87.2. which is 90.25 to 90.25, we'll take the round number, 90.25 into 57339.45. You'll get 517,485.36. Then 101.2 into, next one is what? 6%, no? 6%. In 6% into 6 by 12. This is paid after 6 months. So into 6% divided by 2 plus 101.2. 104.24. 104.24 into 49407.11. You get 5150197.14. Then 116.75 into, what is the interest rate here? Interest rate is 5% into 5% into 6 by 12 into 5% by 2 plus 116.75. You get 119.67. 119.67 into 42826.55. 5125053.24. So here, which is the least? See, in export, you want the most money. In import, you want to pay the least money. So you'll pay this pound. For exports, invoice will be in dollars, and for imports in pounds. Okay, so this is this question. Then let us go to the next one. M&A. X Limited is studying the positive. How many more are there? 12, 13, and I think 14. Yeah, 3 questions only are there. We'll finish off fast. X Limited is studying the possible acquisition of Y by way of merger. The following data is available in respect of both the companies: market cap, gross profit, inventory turnover, data turnover, 12% debenture, 10% debenture, equity shares, OPEX, corporate tax rate, closing stock, debtors. We're going to calculate swap ratio based on EPS and MPS respectively, the weightage of 40%, 60%, and compute post-merger EPS. Post-merger EPS assuming same PE ratio of X and post-merger gain or loss. Okay. So you have to do 2 post-merger stuff. Okay. So let us first note down the data. So market cap is given and equity shares are given. So market cap by equity shares will give you profit. Because what is market cap? Total share count into PAT, or your it is your whatever is the total value of equity. What is value of equity? Value of per equity share is EPS into your PE ratio or whatever. Okay, you'll arrive at value of equity. That value of equity multiplied by total number of shares is market cap. So market cap, how much is it? 75 lakhs, 90 lakhs. 75 lakhs, 90 lakhs. And share count. What is share count? This we have taken 1 lakh and 60,000. 1 lakh 60K. So okay. So market cap is this, share count is this. What do you get if you divide market cap by share count? You get price per share. Okay, per share, what is the price? Multiplied by number of shares that you have will give you your market cap. Price per share is 75 and 90 lakhs by 60,000. 90 lakhs by 60,000 will give you 150 is the share price. Okay, we've got this first. Then share price is given. Then do you get any PE ratio? Closing stock, number of equity shares, turnover. This is price. Do we have any EPS? No, we don't have any EPS. So we have to find out everything. So debtors is equal to 10 lakhs and 8 lakhs. So debtors turnover ratio. 3 times and 5 times, 3x and 5x. So total sales is equal to 30 lakhs and 40 lakhs. Right, then inventory turnover ratio. Why have they given stock also in this one? Okay, then inventory turnover ratio. Inventory turnover ratio is how many times? 5 and 4. 5x and 4x. This is usually inventory turnover is on COGS. Have they given anything about COGS? Closing stock. What is closing stock? Closing stock, they have given some numbers, no? 15 lakhs and 5 lakhs. This is very odd. Let us see. I'll tell you why I'm saying 15 lakhs and 5 lakhs. So, what is inventory turnover ratio? COGS by closing stock is equal to inventory turnover ratio. Implies COGS is equal to inventory turnover into closing stock. So, 15 into 5, 75 lakhs and 20 lakhs. This 75 and 20 and GP ratio. What is given as GP ratio? 20%. And in another case, it is given, in both cases, it is 20% only, no? Yeah, 20%. Implies COGS is equal to 80%. Implies sales is equal to 100%. So basically 80% is 75 lakhs. So 75 lakhs divided by 80%. That will be 93.75 lakhs and 20 by 0.8. This will be 25 lakhs. Now you see here when I took debtor turnover ratio, I got sales as 30 and 40. Here when I took inventory turnover, I am getting a different number. Which one should we consider? See, if you take these numbers, no, you have to choose only one. The other one will not fit the criteria. Okay. See, because if you go by debtor turnover ratio and compute, and they have also not said how many are cash sales, credit sales, nothing. Here if cash sales only so much percentage, then we can take some logic, right? But that also is not there. Closing stock, so we have to choose which one to go with. That is, one of these logics is only right. Both of them are not right. It is impossible both of them can be right parallelly. No, because one of them gives sales of a different number, other one gives sales of a different number. So what do you do? How do you decide? See, ideally both of them can also be taken on average basis. No, what I'm saying is debtors turnover ratio also could have been computed on average debtors. Closing stock, inventory turnover also could have been computed on average stock. But here they have given only closing numbers. So we are taking closing values. But you cannot exclude one saying that this is not computed on average and hence I will do the other one, because both the ratios are done on closing stock, closing numbers only, not on average numbers. So is there any other logic that we are missing why we are getting these two? See, I think no. One of the things is we have found out the price per share 75 and market cap. So we have to see even the EPS. See, price is 75. We also have to see the EPS and find out the PE. See, if you take this number, let's say the PE is very exorbitant, or when you take this number, the PE is logical, then probably that could give us a clear idea. But then is there any way in which we can find out? Okay, let me take this number and proceed, and then we'll see what happens. If things don't work out, then we'll come back. I think that is what they have done in the RTP also. They have taken this number. Let us figure out why, because at the moment I am not very clear why you have to choose this number. Okay, so sales 93.75 lakhs, and they want us to make the P&L. No, that is the first swap ratio. You are required to calculate swap ratio, and all that. For that you need to know the P&L. Then COGS is 75 and 20, 75 lakhs, 20 lakhs. Then GP is 18.75 and 5 lakhs. Then OPEX they have given something, no? Operating expenses 86% and 78%. So operating expenses, if they are 86%, then your operating profit is 14%. So operating profit 14% means what? Your EBIT is 14%, and these percentages are given as part of turnover. 86 and 78, 22%. So EBIT is 93.75 into 14% is 13.125, and 25 into 0.22, you get 5.5. This is odd, no? You are getting an EBIT which is greater than gross profit. This is sounding very, very odd. Even if you do the other way, you will most likely end up the same thing. Okay, anyway, EBIT. Then what do you have? Interest. What is the interest? Very bad question, very, very bad question. 12% on 10 lakhs and 10% on 14.4 lakhs. 12% on 10 lakhs is 1.2 lakhs and 10% on 14.4 lakhs, which is 1.44 lakhs. Then PBT is equal to 13.125 minus 1.2 makes it 11.925, and this is 4.06 lakhs. Then tax, what did they give tax rate? Tax rate they gave it 30%, no? 30%. So 11.925 into 0.3 is equal to 3.5775. PAT is 8.3475. Then 4.06 into 30% is 1.218 minus, you get 2.842 lakhs. So this is the PAT. Now if this is the PAT, what is share count? Share count we had of 1 lakh, no? 1 lakh and 60,000. What is P? 8,34,750 divided by 1 lakh. You get 8.3475, so I'll take 8.35. 2,84,200 divided by 60,000. You get 4.74. This is not P, this is EPS. I don't know why I wrote EPS. So share count is 1 lakh. You divide the PAT by share count, you get EPS. What is the share price? Let us see the share price. What do we write as the share price? 75 and 150. So share price 75 and 150. So what is PE ratio? 75 divided by 8.35 is equal to 8.98, and 150 divided by 4.74 is equal to 31.65. Wow, what a PE. Okay, we've got this PE. Now let us come back to the main question. What is it that they asked? Swap ratio based on EPS and MPS respectively, weightage of 40 and 60. So EPS 8.35, 4.74. So what is the swap ratio? So swap ratio is 8.35 is to 4.74. So here how will you define the swap ratio? See, X is acquiring Y. So Y will have to give all their shares, and in return we will give X shares, correct? So for each share of Y, how many shares of X will you give? That is, if you get 1 share of Y, will you give more shares of X, lesser shares of X? You will give lesser shares of X because X has a higher EPS. So you will give less shares. How much less will you give? You will give 4.74 by 8.35. So 4.74 by 8.35, you will basically give 0.5676. They said how many decimals was? 56. Did they say anything about decimals? They didn't say anything. So I'll take 3 decimals. You will give 568 shares, 0.568. So if you give Y, when Y fellow gives 1 share, you will give 0.568 shares of X. Same way, MPS. What is market price? First guy market price is 75, second price is 150. What is swap ratio? Here also same thing. The target 150 by 75. So when he gives you 1 share, you will give 2 shares. You will give 2 shares. Now, MPS swap ratio, EPS swap ratio. Then weight. This is MPS swap ratio is 0.568. EPS swap ratio is MPS swap ratio is 2, EPS swap ratio is 0.568. And what are the weights? They said weights are EPS is 40%, MPS is 60%. So EPS is 40%, 0.4, 0.6. So 0.4 into 0.568 is equal to M plus, 0.6 into 2 is equal to M plus, memory recall 1.4272. That is, so see here 1.4272, meaning this means that is if Y gives 1 share, they get 1.4272 shares of X. Correct only, no? So here, what was the logic that we said? Because the EPS is higher, y gets one share, y gives one share, you'll get 0.58 shares of x. So by same continuation logic, if you get y gives one share, they will get 1.427 shares of x. Okay, of x. Now what is the second question, boss? This turned out to be a slightly lengthy one. Too many unknowns, what is post-merger EPS? PAT x y. What is PAT? We had some PAT numbers, no? What was the PAT? 8.3475, 2.842. 8.3475. 2.842. What is total? 11.1895. Okay, this is PAT. Now share count. So X original was 1 lakh, Y original 60K, swap ratio 1.4272 shares of X for 1 Y. So 1.4272 into 60,000, you get 85,632. Revised count 1,85,632. So 1,85,632. So EPS is equal to 11,18,950 divided by 1,85,632. 6.027. Okay, 6.027 is the EPS. Then what is the next question? Post-merger market price assuming same PE ratio of X Limited. XPE is equal to 8.98. No, we got. So post-merger market prices, revised EPS is 6.027. So post-merger market price is equal to 8.98 into 6.027. That gives 54.122. Okay, there may be some rounding of errors, ignore that. Then what is the next question? Post-merger gain or loss in EPS. Now EPS X Y pre-merger. What was the EPS we had? 8.35, 4.74. Equivalent shares. You had one share then, you have one share now. What is current EPS here? Current EPS is 6.027. So it is a loss for them. How much? 8.35 minus 6.027 minus 2.323. Whereas the other guys, Y, they were getting 1.4272, right? They're getting, for each equity share of Y, they got 1.4272 shares of X. The EPS that they effectively are getting 6.027 per share, but they have for each share 1.4272 shares. So 6.023 into 1.4272. So they are getting 8.59 as EPS per each share held, whereas they were earlier getting 8.54, 4.74 minus 4.74. If you do, you will get their increase of 4.07. $8.59 minus 4.74 is equal to 3.85. I don't know why I wrote. So they're effectively getting 3.85 rupees increase in EPS, whereas the X guys are getting lower value. Okay, now is there anything else that we have missed? Because it's a very twisted, very dirty, very poorly framed question. Fundamentally because you can compute the turnover using the first ratio also. I don't know why they did not take it. I am unable to know the logic. If you guys are able to figure out that logic, let me know, because it is not at all clear here. You have to randomly assume that debtors don't represent full sales, there is some cash sales or something like that. Otherwise there is no reason, and then also it is not correct because you're getting 40 lakhs here and you're getting 25 lakhs here, so it sounds very, very weird. Anyway, no problem. Let us move forward. And I think they made a mistake here in this current EPS as 6.99 or something that I think they'll correct at a certain point of time, because they themselves know that the EPS is not 6.99 but 6.03. Okay, let us move to the next question. On 1st April, fair return mutual fund following assets at 4 p.m. Okay, number of units is there, so and so. NAV of the fund. What sort of question is this? This is what on 1st April. If it is simple multiplication, this is what horrible question is this? 39.4 into 20,000 is equal to M plus 965.2 into 1 lakh is equal to M plus 20,000 into 528.8 is equal to M plus 1349.8 into 2 lakhs is equal to M plus 51.8 into 60,000 is equal to M plus memory recall divided by 16 lakhs. 1 crore 60 lakhs. How many 6 zeros? 1, 2, 3, 4, 5. 5 zeros. 16 lakhs. That is 238.095. First one answer is over. Assuming on 1st April, HNI sent a check of 2 crores to the fund and the fund manager immediately purchased 36,000 shares of C and the balance is held in bank, then what will be the position of the fund? What do you mean what will be the position of the fund? It will be the same thing, no? What is the big deal in this? I didn't understand what they're trying to ask. 36,000 shares of C on 1st time, 2 crores. What sort of question is it? It's just simply addition of this, that's all, nothing major. Then what will happen? 36,000 shares of C. So C, instead of being 20,000, C will be 56,000. So this will be 56,000 at 528.8. Now 36,000 into 528.8 is equal to 1 crore 90 lakh 36,800 minus 2 crores. You also have cash. So then you'll add cash 9 lakh 63,200. There's nothing beyond this. There's nothing. Now the market price is follows. What will be the new NAV? What will be the new NAV? So after making this addition of C is what basically they are saying on 2nd April at 2 p.m. So in this question, I think they made a mistake. The answer has a different one and question has a different one. These three numbers, whatever I am highlighting, they're actually double their value, okay, in the answer. So we have to take them as 581.6, 1343.8, 88.4. This is what happens when they copy data from somewhere and don't change the numbers. 40.6 into 20,000 is equal to M plus 1027.4 into 1 lakh is equal to M plus 56,000 into 581.6 is equal to M plus 1343.8 into 2 lakhs is equal to M plus 88.4 into 60,000 is equal to M plus. If you do memory recall, you get 41 crores 1 lakh 85,600 plus cash. Cash was 9 lakh 63,000. So total AUM will be 9 lakh 63,200. 41 crores 11 lakh 48,800. Okay, now what is the unit count? See, earlier we had a NAV of 238. Round of all calculation to 2 decimals. Okay, that we'll do. See, when you invested 2 crores, 2 crores is 2 plus 7 zeros. Divide by 238.095, I'll take it as 1. 238.1. So you allotted, originally there were 16 lakh units. You allotted another 83,998.32 units. So plus 16 lakhs is equal to, you get, so the unit count now is 16 lakh 83,998.32. So what you'll have is 41,1148,800 divided by 16 lakh 83,998.32. So revised NAV will be 244.15. Revised NAV will be 244.15. So I have not actually done a detailed problem. This is very simple. I don't know why they gave a question like this, but they goofed up the numbers. Okay, that's what I was wondering when I was solving. What is this nonsense? Anyway, last question. Following financial data is available. So and so, you require to draw income statement for their calculate sustainable growth rate. So basically, this is some kind of a this one. Ratio analysis of CA Inter. Okay. Now you have income statement. What is income statement here? You are total asset turnover ratio. So assets is 600. So asset turnover ratio is what? What do you mean by asset turnover ratio? Turnover by asset is 1.1. So turnover is X divided by 600 is 1.1, meaning turnover is 660. So turnover is 660. First line item we got. Then operating margin is 10%. So EBIT is 66, 10% of that. Then total assets over, this is over. Equity shares and surplus. See here, this is equity and reserve and surplus is 400. 400 plus 175 is 575. So other data is missing, but assets is 600. So probably 25 is your working capital and all of that. Okay, we'll see that. They did not ask us for a balance sheet. They only asked us for interest statement. Okay, EBIT. Then interest. What is interest? You have two bonds. 8% 125. So 125 into 0.08 is equal to M plus 50 into 0.1. No, they have given an effective interest rate of 8%. So we should take effective interest rate of 8%. So on 175 into 8% is 14. So 14, you get PBT of 52. Then you subtract tax at 40%. 52 into 0.4, you get 20.8. You get minus 52, we do 31.2 is PAT. 31.2 is PAT. Then they've given what? Payout ratio. Dividend is 1/6. So divided by 6, you get 5.2. So EAESH is equal to 26. Now current market price is 14. We drew the income statement. What are they saying? Sustainable growth rate. So P0 is equal to D1 by KE minus G. Current market price is 14. Dividend is 16, and cost of have they given KE? They have not given KE, so we cannot do it by this way. What is G? We have not do it this way. What is G? G is equal to B into R. What is required rate of return? No, we can. They have given required rate of return of investors, so we can actually find out KE. Now, see, this R is ROE. This R here is ROE. Now, can we compute ROE? ROE is your PAT by net worth. What is PAT? 31.2. What is net worth? You have got here 400. So this is 31.2 divided by 400. You get 7.8%. What is your retention? Retention is equal to 1 minus 16.67%. So 7.8 into 5 by 6. That gives you 6.5%. This is one way to compute. Other way is, this is what they have given in the RTP. Other way, if you ask me, right, is current price is 14 is equal to D1. Next year's dividend, so which is current year dividend is how much? Have they given the shares, number of shares? Current price of the share they have given, but number of shares. Equity shares of 10 rupees each. So 100 lakhs by 10 rupees is how much? You have 10 lakhs. So share count is 10 lakhs. Right, share count is 10 lakhs and your PAT is 31.2, or your dividend is 5.2 lakhs. So your dividend is equal to 0.52 is your dividend, because 5.2 lakhs is the dividend, 10 lakh shares are there. So each person you pay 0.52, D0 is 0.52 into 1 plus G by K, which is 15 minus G. You can also do like this. So 14, which is current market price, is equal to D0, which is 0.52 into 1 plus growth divided by 15% minus growth. Right, this can also be done. So 14 into 15% is 2.1. So 2.1 minus 14G is equal to 0.52 plus 0.52G. Okay, or you take all G together one side. 2.1 plus 2.1 minus 0.52 is equal to 14.52G. 2.1 minus 0.52. 1.58 is equal to 14.52G, or G is equal to 1.58 divided by 14.52. You get 10.88%. You can theoretically work out this way also, okay? But I don't know why they choose only one method. See, it's not. See, you have given part data, boss. I mean, this is so unfair. that you can give half data from here, half data from there, then partly you don't give the data. It's very, very unfair. But I think, they've given answer as, sustainable growth rate as 6.5 and all of these are the data. Very, very simple. Other than that, there's no complication. So my suggestion, if there are ways like this or questions like this where two answers are possible, you say solution 1, alternative solution 1, especially if you have time. If you don't have time, then there's a different question. And I really hate this mistake here, what they have made with respect to prices. Then I also hate the mistake what they have made here with respect to this question, where they have given both data turnover ratio as well as inventory turnover ratio. I don't know what is the logic for giving that. Okay, fair enough. This concludes the RTP. So, if please do visit our website. If you wish to enroll in our classes, please do like, share, subscribe to my videos. Do follow me on Instagram. And in case of any doubts, please reach out to us. We're more than happy to assist you. Chaliye, all the very best.